In the most recent budget, the Chancellor made some big changes to pensions, and I made a really quick and dirty video the day after, which I'll link to in the description. But as ever, the devil is in the detail, and now that we've had some time to digest the changes, and if you're likely to be affected by them, the question has got to be, now what? Hi and welcome back to the channel. My name is Pete Matthew and I'm a chartered financial planner based in the UK, and this video is brought to you by Meaningful Academy Retirement Planning. More on that a little bit later. So understandably, I had a load of comments on the last video. Lots of conspiracy nutters, which we obviously largely ignore. Lots of people complaining about the seeming inequality that the changes appear to engender, and I definitely have some sympathy for that. But I have no intention of getting political here. That's just not my job. My job is to help my clients and you to take advantage of the system as it is right now. And that's potentially the biggest problem with taking action on the back of these changes. The Labour Party have made it very clear that they intend to revoke some or all of these changes and definitely plan to reinstate the lifetime allowance. I've got something to say about that, and that'll be at the end of this video. So let's dig into the detail a little bit, prompted by some comments received on the last video. So firstly, Kevin asks if I can cover the lifetime allowance changes that are happening from April 2023 and then the changes that are happening from April 2024. Well, the change to the lifetime allowance coming into force in a couple of weeks from when I'm recording this video, from the 6th of April 2023, is simply that there will be no LTA charges levied in that tax year. There is still going to be tests and questionnaires and crystallization certificates and all that sort of stuff. But if you have a charge to pay, you just won't have to pay it. But from April 2024, the LTA will be abolished altogether, so benefit crystallization events will cease to exist. There will be no tests and no charges. And that answers Ray's and other people's questions about the age 75 test. But until then, again, pension providers still have to go through the motions of doing these benefit crystallization event tests, issuing certificates, all that, but there's just no LTA charges to pay. The legislation formally to abolish the lifetime allowance will come in the Finance Act 2024. So that'll probably be, I don't know, early 2024 that'll finally get passed. And it will pass, though. Conservatives have a big majority, after all. The initial motion on the day of the budget to proceed with these changes passed by a margin of 97 votes. So it's unthinkable that the full bill with all the detail in it won't pass. It just won't pass for another year or so. So Nick asks about how pensions will be taxed now that the lifetime allowance is going to be abolished. His understanding, according to his comment, is that we paid 55% tax above the lifetime allowance charge, and he asks whether that has changed. Well, what's actually the case is that if you take out any pension fund in excess of the LTA, you do pay a 55% charge. But if you leave it in, you only pay 25%, and that's called the scheme pays option. But of course, if you subsequently do take that money out down the line, you're going to pay income tax on it. So here's an example. Let's just say that your pension fund exceeds the lifetime allowance by £100,000. You opt to leave that money in the scheme for now and pay the 25% scheme pays charge on it. That's £25,000 in lifetime allowance charge. Now later on, you decide you're going to take the £75,000 left in as a lump sum into your bank. Assuming you pay 40% income tax, then that's £30,000 in tax. Add that £30,000 to the £25,000 that you've already paid and you get £55,000. That's 55%. Exactly the same as if you took out the excess on day one. But of course, there is no LTA charge anymore from April 2023. So instead, anything you take out over and above the tax-free cash element is just going to be taxed at whatever your income tax rates are, 20%, 40%, or 45%. Now, talking of tax-free cash, there's some nuance to the announced changes that we need to understand. Loads of people asked about this, including Martin. Jeremy Hunt said that the tax-free cash from a pension is going to be limited to 25% of the current lifetime allowance. So that's $268,275 maximum tax-free cash. And we're going to need to take that as gospel for now. And that's simple enough in practice. Anything over that amount will be taxable when you draw it. It gets a lot more complicated though if you're in a DB scheme, especially if that scheme has a contractual obligation to pay you more tax-free cash than the new maximum. I don't really think that kind of detail has been worked out yet. Also, if you've maybe already taken benefits from a DB scheme and chosen not to take any tax-free cash, and maybe you've got a DC pot alongside, what is the tax-free cash from that pot limited it to? Is it 25% of the difference between your DB benefit and the lifetime allowance, or what? And the answer again is we don't know. That hasn't been confirmed by the revenue yet. Now, there's quite a bit of discussion in my profession about whether these changes, this capping of the tax-free cash, are actually signaling the end of tax-free cash from pensions, but I don't think so. It does mean, though, that as pension funds get bigger, more of that money will be taxed if it is taken as income. But if not, it's just going to sit in the pension fund, ready to be passed on to beneficiaries, currently free of inheritance tax. More on that in a bit as well. Really importantly, though, if you have an enhanced protection or any of the fixed protections, you will have the benefit of a tax-free cash amount that is higher than this new 268,275 maximum. Those protections are broken if you make a pension contribution, but according to the gov.uk pensions bulletin, which I'll put a link to in the description, it looks like even if you break your protection by adding more into your pensions, you will retain the higher tax-free cash granted by your protection. That's pretty valuable for a lot of people watching this. Now, Andy asks whether it's worth holding onto his LTA Protection certificate just in case it gets reintroduced at a later date. Well, I would definitely do that if I were you, but I have to think that if it does get reintroduced, there's going to need to be some kind of new transitional arrangement that protects those with pension funds higher than whatever level they reintroduce it at. I mean, that's what's happened each time the lifetime allowance has changed up to now. And we haven't even mentioned the annual allowance yet. Well, this is rising from $40,000 to $60,000 a year from April 2023. The money purchase annual allowance has risen from £4,000 to £10,000 a year, and so has the tapered annual allowance for high earners. Michael asked about this, and so did quite a few more of you. Importantly, the rules about how to contribute to a pension haven't really changed. You can still use carry forward, but for each year that you do, you can only use the annual allowance as it was in the year that you're carrying forward. You still need relevant earnings in the year that you are making the contribution to cover the amount that you're looking to contribute. If you haven't got any relevant earnings, the maximum you can contribute into a pension is still £3,600 gross or £2,880 net. The money purchase annual allowance is not triggered by taking benefits from a DB scheme. A few of you asked about that as well. Nothing has changed there. Well, this is getting pretty technical, certainly the deep end of the pool, as we like to say here. But before we answer the question, now what? I need to ask you for a couple of favors. First, hit the like button on this video and subscribe to the channel if you're not already. It really helps me out, and it helps you to stay on top of things by seeing all my videos in your feed, auto-magically. Secondly, check out Meaningful Academy Retirement Planning, which is my online course where I distill all my teaching about how to plan and execute a successful retirement. As well as tons of video lessons, there are worksheets, calculators, access to world-leading financial planning software, and best of all, a community of people in similar situations to you, all looking to help each other out. So head over to meaningfulacademy.com/retirement planning, and if you decide that it's for you, use the coupon code YouTube for a decent discount. So, now what? What should we do now in light of these changes? Well, let's assume for a moment that Labour get in at the next general election. It's quite likely, let's face it. That's going to be January 2025 at the latest, I believe. Now, let's further assume that they make legislation to reintroduce the lifetime allowance in the March 2025 budget, perhaps to kick in April 2025. That means that you have 2 years to take advantage of these changes as they happen from 6th of April 2023. So if you are likely to have a pension in excess of the lifetime allowance, you could think about crystallising in the next 2 years, assuming you're of an age where you can do that and you're in a scheme which allows you to do that. Remember though, don't let the tax tail wag the dog. Always think about what your needs are and then try and work it around the legislation, not the other way around. If you're in a position to contribute up to the new higher annual allowance, clearly it makes sense to do so. That's tax relief in your pocket now. Never mind what the lifetime allowance does one day. They can't take the tax relief that you get next year away from you in the future because you've already got it. Likewise, if you have a business which can make contributions for you, totally makes sense to continue doing that, especially at the new higher rate of corporation tax, which is confirmed at 25%. If you have income between $100,000 a year and $160,000 a year, it makes sense, if you can, to pay enough into pensions to bring your income down and restore your income tax personal allowance. If you're in a DB scheme, the new higher annual allowance will mean that you're less likely to exceed it in any one year, and there could be more carry forward that you can use in future years. If you're a high earner, the tapered annual allowance has more than doubled, so you can sock away $10,000 instead of $4,000. Don't waste that opportunity. And if you're subject to the money purchase annual allowance, you can still put £10,000 a year away if you have the relevant earnings to cover it. Now, I said all of those action points last week, and nothing has changed for me, even if Labour get in and reverse these changes. I think you must plan for the situation now and worry about changes as and when they happen. For goodness sake, don't refuse to take advantage of better reliefs now, just in case changes are made in the future. That's just madness. Here's the truth. Changes will be made in the future, no matter the colour of the political party in government. I believe that for any future changes, there's going to have to be transitional arrangements put in place to protect those affected by reducing the allowances. But I think that the lifetime allowance is so complicated that they probably won't reintroduce it, no matter what Keir Starmer says. If I had to call it, I would say that the tax-free cash limit will stay. I also think that future governments will look at the inheritance tax-free nature of pension funds and probably go after that benefit. Now, I wouldn't know where to begin costing it, but I'd have to think that they'd get more of a tax take from that than from reducing the lifetime allowance. Maybe they have a limit on how much pension can be passed inheritance tax-free and then tax the excess on death, kind of like a pension nil rate band. If they call it that, you heard it here first, right? I do wonder if the annual allowance will be reduced. Again, I was really surprised that the Chancellor put that up at all. And longer term, I wonder if pension tax relief will be standardised to, say, a flat 30% across the board. That would incentivise normal earners to save because they get more tax relief than they get now, but it wouldn't overly benefit higher earners. That just kind of seems fairer to me. But all those changes, if they happen at all, are in the future. Right now, or from April the 6th, 2023 anyway, there are a new set of rules to work within, so let's make the best of them while we can. I hope this was helpful. If it was, you know what to do. Like, subscribe, and share. Recently, I did a kind of retirement masterclass video, which might be a good one to watch next. You can click it just over there. But thank you so much for watching this one, and I will see you in the next video when I'll probably have my lighting a bit more sorted again.